Welcome to the Deep Dive. Today we're plunging into something big, maybe a bit different, not a stack of articles this time, but excerpts from a single, really extensive document. Looks like a major piece of proposed legislation.
That's right. And what's striking immediately, I think, is how this document doesn't just stay in one lane. It weaves through so many different areas of life and policy. It really shows you how interconnected, seemingly separate things can be, in federal law.
Absolutely. So our mission today is basically to navigate this pretty dense text. We're going to try and go section by section, pull out the most significant nuggets of knowledge, insights, highlight the changes and provisions that are particularly noteworthy or might have a direct impact on you.
Yeah, it's a bit like trying to find the key threads in a huge tapestry, isn't it? The only way to really make sense of it is to break it down piece by piece.
Okay, let's do that. Let's unpack this document and see what's actually inside. We should probably start with just the broad strokes, like how much ground does this thing cover?
Well, my first impression was exactly that, the sheer scope. This isn't a bill about just one thing, not at all. It's got sections on Medicaid, taxes, agriculture, defense spending, education, immigration, energy policy, federal lands, transportation. I mean, it's a really wide spectrum.
And that breadth, that's precisely the challenge in understanding it, right?
Yeah.
You can't just read one part in isolation because changes in one area might easily affect another. So breaking it down by topic, like we're going to do, seems essential to really grasp what's happening. Let's jump into the first big section then, healthcare and social programs, looking at changes related to Medicaid, SNP, and the Affordable Care Act. The Medicaid stuff here looks quite detailed.
It is, yeah, very detailed. The document includes some really specific prohibitions right off the bat. For instance, it prevents what's called abusive spread pricing.
Okay, what's that exact?
It's a practice where middlemen, basically, in prescription drug transactions, might charge Medicaid programs more than they actually pay the pharmacy, and then they just pocket the difference. This aims to stop that. And it's also explicit in Section 44125 about prohibiting federal funding for gender transition procedures. And it lists other prohibitions, too, on federal payments going to certain entities in Section 44126. Just to be clear, we're presenting these points directly from the source text, just reporting what it says.
Understood. Impartially reporting. It also seems to dig into the financial mechanics of Medicaid itself.
It does, yeah. There's language that sunsets eligibility for increased FMAP. That's the federal medical assistance percentage, basically, the federal government's share of Medicaid costs. This applies to new states that expanded Medicaid. It includes a moratorium, a pause on new or increased taxes that states might impose on healthcare providers, and it revises how state-directed payments can work within Medicaid.
What's really catching my eye here are the changes aimed at tightening up eligibility and enrollment integrity.
Yes, that's a big focus. The source mandates that by October 1st, 2029, and that's a very specific date, years out, states have to have a system in place to prevent people from being simultaneously enrolled under multiple state Medicaid plans.
It's trying to stop potential double dipping across state lines.
Exactly. It's a clear push for some kind of national level coordination or system.
Interesting detail, that future deadline for a concrete system change. And it says managed care entities have to transmit address information to states starting January 1st, 2027.
That's right. And then beginning January 1st, 2028, there are new requirements for states. They have to screen enrolled individuals quarterly against the Death Master File.
The government database of deaths.
Yeah, to make sure benefits aren't going to deceased individuals. And the same quarterly check is required for providers and suppliers starting that same date. It really emphasizes a focus on, program oversight.
Makes sense. The document also mentions removing the good faith waiver for payment errors.
It does. That waiver could sometimes excuse states for certain errors. Removing it suggests less tolerance for mistakes. And it introduces a new definition for a Medicaid taxable unit, which relates to how certain state healthcare taxes interact with federal Medicaid rules.
Okay, so beyond the financial and integrity systems, there's a whole section on community engagement requirements for Medicaid eligibility.
Yes, quite a bit on that. States must verify that individuals meet these community engagement requirements when their eligibility is redetermined, or maybe even more often.
And they're mandated to use ex parte verifications where possible. What does that mean again?
It means using existing data the state already has on file, like wage data, perhaps to verify eligibility. Rather than making the individual submit documents over and over again, it's meant to be more efficient.
Okay. And states also have to clearly notify people about the requirement itself.
Yeah, about the requirement, any exceptions, the consequences if you don't meet it, and how to report changes in your situation.
And the text defines who this applies to, the applicable individual.
Right, basically those receiving benefits. And it lists what counts as community engagement. And it's actually broader than just having a job. It includes things like job searching, education, volunteering, caregiving, also participation in substance use disorder treatment, or having recognized medical frailty.
Ah, so there are defined exceptions too. That seems important.
Very important. You're exempt if you have medical frailty, are in substance use disorder treatment, are pregnant, have specific caregiving responsibilities, or if you're temporarily ill, live in an area with officially high unemployment, or you're a student. The insight here is that the legislation isn't just dropping a requirement, it's trying to define it and its boundaries pretty carefully.
And to help states actually do this, the document mentions grants.
Yeah, states are eligible for government efficiency grants to help set up the systems for these changes. And the HHS secretary, the head of Health and Human Services, is required to issue guidance on initial implementation by December 31st, 2025. Notice how the document often includes these specific dates and practical steps alongside the bigger policy mandates.
Okay, let's shift over to the Supplemental Nutrition Assistance Program, SNAP, food assistance. We see some adjustments here to the Thrifty Food Plan. That's the basis for calculating benefits, right?
Correct. And now its adjustments will be tied directly to the Consumer Price Index, the CPI, annually on October 1st. So this links benefit levels directly to inflation as measured by the CPI, which could be significant depending on inflation rates.
Section 1004 brings changes to how household composition affects SNAP eligibility, specifically around elderly or disabled members.
Yes, it modifies how their presence is factored into the calculations for eligibility and the actual allotment amount.
And Section 1005 adds new restrictions, something about internet expenses.
Right. It limits how internet expenses can be considered when determining SNAP eligibility or benefit levels.
Okay, and Section 1010 seems to clarify residency requirements.
It does. It states you must be a resident of the United States and a citizen, a national, or a qualified alien. It also specifies that if someone in the household is ineligible for SNAP, maybe due to immigration status, their income and resources are still considered when calculating the benefit amount for the eligible members in that household.
Got it. And finally for SNAP, Section 17010 includes mandatory funding for emergency food assistance.
Yeah, ensuring continued support for things like food banks and similar programs seems like a baseline commitment there.
Okay, now let's turn to the Affordable Care Act,
Yeah.
the ACA, and health insurance through the exchanges, the marketplaces. The document includes changes to how immigration status is verified for premium tax credits.
Yes, those are the subsidies that help lower monthly premiums. It tightens up verification related to immigration status. It also just reiterates that people getting advanced premium tax credits must file a tax return and reconcile those credits annually. That's actually current law, but may be emphasized here.
Okay, but here's something that sounds, well, really interesting, maybe even surprising for marketplace consumers. It says it prohibits automatic re-enrollment from a bronze-level plan to a silver-level plan on the exchanges.
Yes, that's a potentially big change, effective for plan years starting on or after January 1st, 2026. The insight is, right now, if you're in a bronze plan and do nothing during open enrollment, the system might automatically move you to a similar silver plan, often seen as a step up in coverage but with higher premiums. This would stop that automatic bump. It forces a more active choice from the consumer each year if they want to change metal levels.
Huh, okay. And it also adds an exclusion from premium tax credits for certain lawfully present aliens who are ineligible for Medicaid because of their alien status.
Right. It carves out their specific group from eligibility for the premium subsidies.
There are also modifications mentioned to the rules for individual coverage health reimbursement arrangements, ICHRAs.
Yes, ICHRAs. Those are arrangements where employers give employees money to buy their own individual health insurance instead of offering a group plan. The document tweaks the rules around those.
And this looks interesting provisions allowing people to terminate flexible spending account, FSA, and health reimbursement arrangement, HRA balances, and move the money into a health savings account, HSA.
Yeah, it labels this a qualified HSA distribution. It offers a new potential flexibility. If you have money left in an FSA or HRA, which often has use it or lose it rules, This could let you roll it into an HSA, which you own and keeps growing tax-free.
That could be useful. The document also clarifies a rule about spousal FSAs impacting HSA eligibility.
Right, it gets into the weeds a bit there. If your spouse has an FSA, it can sometimes make you ineligible to contribute to an HSA. This clarifies the rule, particularly if the reimbursements from the spouse's FSA don't exceed your combined expenses. Plus, it mentions changes and inflation adjustments related to the HSA contribution limits themselves.
Wow. Okay, so just within that healthcare and social programs part, we've seen specific policy prohibitions, a big focus on program integrity, new engagement requirements, direct links to inflation for food benefits, and yeah, even surprising shifts in how health insurance auto-renewal might work. That's a lot packed into just one area.
Definitely. It really covers a lot of ground.
All right, let's shift gears pretty dramatically now and look at the tax policy shifts outlined in the document. This section looks like it could affect a lot of individuals and businesses.
Yeah, it really touches on numerous areas. It lists extensions or, in some cases, terminations of several existing tax deductions and limitations that people might be familiar with. Things like the deduction for qualified residence interest, mortgage interest, casualty losses, miscellaneous itemized deductions, even really specific ones like the deductions for bicycle commuting and moving expenses, which were changed significantly in recent years.
Okay, so tweaking existing deductions.
Right. It also modifies business deductions, like the limitation on deducting business interest expense. And it touches on complex international tax provisions like GILTI, that's Global Intangible Low-Taxed Income, and BEAT, the Base Erosion Minimum Tax Amount. The main insight here is just how many different parts of the existing tax code this document reaches into, right? It's not just adding totally new things.
It does mention the exception allowing deductions for business meals is extended, though.
Yes, that one gets extended. But now let's talk about some genuinely new deductions proposed here. Section 225 introduces a deduction for qualified overtime pay.
Overtime pay, how would that work?
Well, what's notable is under Section 63B, it says you're allowed to take this deduction even if you don't itemize your deductions. You take it above the line. You just need to provide a correct Social Security number.
That could be significant for wage earners. Is it permanent?
Good question. No, it's explicitly temporary. The text says it terminates for taxable years beginning after December 31st, 2028. So it's designed as a few years of potential tax relief on overtime income.
Okay. And there's another new one, Section 226, deduction for vehicle loan interest.
Yeah, a deduction for qualified passenger vehicle loan interest. This applies to interest paid on debt that's incurred after December 31st, 2024. So future loans. And it has to be for purchasing a vehicle, new or used, for personal use, and secured by a first lien on the vehicle.
So your regular car loan interest could potentially become deductible.
Potentially, if it meets all those criteria. The document also requires lenders to report this interest, presumably to the IRS and the borrower, to make the deduction possible.
Interesting. Okay, what about for small businesses?
The credit they can claim for providing paid family and medical leave that gets extended, and the calculation changes a bit. The percentage of the credit depends on the percentage of wages the employer continues to pay during the leave. More generous leave, potentially a bigger credit, but businesses need to have a written paid leave policy to qualify.
And modifications to the small employer health insurance credit, too.
Yes, that one gets modified as well. Details probably matter there.
Now, on the education front, it looks like it expands what counts as a qualified elementary or secondary education expense for tax-advantaged accounts.
It does. The insight here is it's broadening the types of K-12 expenses that might qualify for things like 529 plan distributions or other educational savings benefits. It now explicitly includes tutoring, general school supplies, dual enrollment fees for college courses taken in high school, and significantly, it adds educational therapies, things like occupational, behavioral, physical, and speech-language therapy.
That could be a big deal for families using those accounts, especially if they have kids needing specific support services.
Absolutely. It could offer more flexibility. The document also creates an exclusion from gross income, meaning it's tax-free for certain K-12 scholarships. These have to be provided by what it calls qualifying scholarship granting organizations.
And it defines what makes an organization qualifying.
Yes, the text lays out requirements for those organizations. Things like verifying recipient income levels, undergoing independent audits, making sure the scholarships meet certain standards. It's trying to put guardrails around these tax-favored scholarships.
Okay, now, here's a section that seems, well, it introduces an entirely new concept, doesn't it? The document establishes a new type of trust account, And it explicitly refers to it as a Trump account.
Yes, that's the terminology used in the text. It's established in Part 9 of Subchapter F of Chapter 1 of the Tax Code, according to the document, a whole new section for this account type.
Okay, so the document creates a brand new type of savings vehicle using that specific name. What are the specific features outlined in the source for this Trump account?
Well, as described in the text we have, it has an annual contribution limit of $5,000 per year. It's set up for a designated beneficiary. Both the person setting up the account and the beneficiary need to provide Social Security numbers. And it has investment limitations. It explicitly says you can't invest in collectibles like art or antiques.
Okay, and how does the taxation work for these accounts, according to this document?
The earnings are taxed when the money is withdrawn. There are potential penalties outlined for certain withdrawals, but the text also lists specific exceptions where withdrawals would be penalty-free, and it allows for rollovers between these types of accounts.
So the earnings grow, but you pay tax on the way out, kind of like a traditional IRA in that sense.
Somewhat, yeah, in terms of when the tax hits the earnings. Though the contribution limits and other rules seem distinct, the insight really is thinking about where this fits compared to existing accounts like IRAs, Roth IRAs, 529 plans. It's presented as a distinct structure with its own unique set of rules. Its creation itself would be a pretty significant tax policy change.
And the source mentions a specific program linked to these accounts, a pilot program.
Yes, there's a Trump Accounts Contribution pilot program detailed in the text. This program, as described, provides a one-time $1,000 tax credit per eligible qualifying child, presumably linked to contributions to these accounts. Again, just to reiterate, we are strictly reporting the names and provisions as they're written in the source document we're analyzing, presenting the information impartially, no endorsement or interpretation implied.
Understood. Okay, one more tax item here. The excise tax on private foundations.
Right. The tax on their investment income. This document increases it. And it establishes a tiered rate structure based on the foundation's asset value. For foundations with assets over $50 million, the rate starts at 1.39%. Over $250 million, it goes up to 2.78%. Over $5 billion, it jumps to 5%. And there's a top-tier rate of 7.5% for the very largest foundations.
So a progressive tax increase hitting larger foundations harder.
Exactly, tied directly to the size of the foundation's assets.
Okay, so yeah, the tax section alone reveals some pretty significant changes, from small new deductions for individuals to creating entirely new savings structures and adjustments for large nonprofits. It's broad.
Very broad.
Let's move on then to business and economic measures, including provisions focused on rural America and Main Street businesses.
Okay. This section includes an extension of the special depreciation allowance for certain property, sometimes called bonus depreciation or full expensing. The insight here is this lets businesses write off the full cost of qualifying assets much faster, often in the first year. It's meant to encourage investment.
And it also addresses opportunity zones, those areas designated for economic development incentives.
Yes, it renews and enhances the Opportunity Zone program. And it includes specific rules tailored for rural areas, things like making it easier to increase the tax basis in investments there. And it actually reduces the requirement for improving existing buildings in rural opportunity zones. Instead of having to double the building's value through improvements, it's only a 50% increase required in these rural zones.
Making renovation potentially more appealing in those areas.
Could be. And interestingly, the document specifically mentions data centers in relation to these rural opportunity zone rules, perhaps signaling an intent to incentivize that kind of tech investment in rural areas.
The document also increases the dollar limitations for expensing certain business assets under Section 179.
Right. Section 179 expensing. It's another measure letting, typically smaller, businesses write off more equipment purchases immediately instead of depreciating them over time. Raising the limit enhances that benefit. It also repeals a revision related to reporting thresholds for third-party network transactions, think platforms like eBay or Etsy. This might simplify tax reporting for some sellers on those platforms.
And there's a specific tax break noted in Section 111-106, something about rural property loans.
Yes, an exclusion of interest income received on loans secured by rural or agricultural real property. This is a targeted incentive for lenders, potentially aimed at making it cheaper or easier to lend for farms or other rural property.
Okay, what about research and experimentation, R&E?
On the R&E front, the document includes temporary rules for domestic R&E expenditures under a new Section 174A. The key insight is that for a limited time, specifically until December 31st, 2029, companies can fully expense these U.S.-based R&D costs in the year they incur them. which is a change from current law requiring amortization over 5 years. So it's a significant but temporary tax benefit for domestic R&D.
And what about research done outside the U.S.?
Conversely, the document requires R&E expenditures conducted abroad to be amortized over 15 years. So it creates a very clear tax difference, favoring domestic research over foreign research activities.
Got it. The document also touches on controlled foreign corporations, CFCs.
Yes, it gets into that complex international tax area dealing with CFCs and partnerships. It includes provisions related to income earned from countries deemed discriminatory foreign countries. It allows for a potentially increased U.S. tax rates or a broader tax base on that specific income. Suggests a focus on international tax fairness or perhaps retaliation, as defined by the legislation.
Okay, now let's dive into these sector-specific appropriations and directives. This is where it gets into very concrete spending amounts and policy goals for different parts of the government and the economy.
Right. In defense, the document details significant appropriations, meaning funding, for specific missile and defense programs. The source actually lists specific dollar amounts for things like long-range multi-service cruise missiles, short-range Navy and Marine Corps anti-ship missiles, and also updates to strategic systems like the Trident D5LE2 submarine-launched ballistic missile. And it even includes funding designated for a nuclear-armed sea-launched cruise missile. The insight here is seeing exactly which defense capabilities are being prioritized with these specific funding numbers.
It also includes substantial loan guarantees, up to $100 billion.
Yes, for the defense industrial-based technology sector. The idea is to boost innovation and production capacity within the companies that supply the military. And it provides specific NNSA appropriations for fiscal year 2025. That's the National Nuclear Security Administration, which handles nuclear weapons and related materials.
What about the Coast Guard?
For the Coast Guard, there's funding allocated for new vessels, a dry dock, improving maritime domain awareness, knowing what's happening offshore, and developing autonomous systems. But the document adds a restriction on the dry dock. A new one can't be acquired unless a national security exception is formally justified and Congress is specifically notified. Shows a bit of legislative oversight on big acquisitions.
Okay, moving to agriculture, what's in there?
The document includes provisions on base acreage calculations for certain crop years. That affects farm program payments, and how non-covered commodities crops not typically part of major subsidy programs are treated in relation to disaster assistance.
It sets rules for marketing assistance loans based on world market prices.
Yes, those help farmers manage cash flow when prices are low. And it determines storage rates for sugar that's forfeited to the government under the sugar program. And here's a specific action mandated by the bill. It requires a study within 180 days of enactment on refined sugar imports, focusing specifically on how refined sugar is defined and what standards apply. A clear, time-bound directive targeting a specific agricultural market issue.
Okay. Energy and environment looks like some changes here, too.
Yes, we see direct rescissions, which basically means cuts of funds that were previously allocated by the Inflation Reduction Act. This document specifically targets programs like state-based home energy efficiency contractor training grants and certain Department of Energy loan programs for clean energy. It zeroes out that funding.
Sure.
So the insight is, this bill is explicitly rolling back funding for certain clean energy and efficiency initiatives passed previously.
It also mentions significant permitting reform for energy projects.
It does. The insight here is a push to streamline the approval process. It establishes a standard one-year deadline for federal agency actions on permits, and it sets new standards for how judicial reviews court challenges of those permits will be handled. The overall aim seems to be speeding up the development process for energy infrastructure, potentially pipelines, transmission lines, etc.
And this sounds interesting, almost novel.
Yeah.
An energy project cancellation compensation fund.
Yeah, that's a fascinating mechanism. It would be funded by the project sponsors themselves, the companies building the project. And it's designed to compensate them for losses if their project is canceled later due to a qualifying federal action. Maybe a permit gets revoked or a new regulation stops it. It's a risk mitigation approach, shifting some of the cancellation risk onto project developers via the fund contributions, but offering a potential payout if a government action is the specific cause of cancellation.
The document also imposes new fees for renewable energy projects on public lands.
Yes, requirements for annual acreage rent and capacity fees based on how much energy the project can produce. This changes the economics for solar, wind, and potentially other renewable projects sited on federal land.
And similar to the energy programs, there are rescissions of funds mentioned for the Forest Service, National Park Service, and Bureau of Land Management.
That's right, cuts impacting the budgets for managing public lands and national parks.
And there's a particularly specific output target in this section for the BLM.
Yes, a directive for the Bureau of Land Management to increase timber harvest volume on the lands they manage by at least 25% over recent averages. And they need to achieve this within 1 year of the bill's enactment. That's a very concrete goal for federal land management policy.
Okay, let's look at the immigration section. A significant appropriation mentioned here.
Yes, $12 billion appropriated to the Department of Homeland Security for fiscal year 2025. And importantly, these funds are available for several years until September 30th, 2029. This funding is explicitly designated for state border security reimbursement.
Meaning money going to states.
Yes, intended to help states cover costs they incur related to border security, things like detention, notifying federal authorities, sharing information. The insight is the sheer scale of this specific state-focused funding stream.
There are also increased fees mentioned for immigration court filings.
That's right. Fees for things like motions to reopen a case, applying for suspension of deportation or cancellation of removal, those fees are set to increase. The text gives specific minimums, like $400 for motions to reopen, $800 for suspension or cancellation applications. And these fees will be adjusted annually for inflation. And significantly, the fees collected will be retained by the Executive Office for Immigration Review, the agency that runs the immigration courts, potentially funding their operations.
The document also authorizes increased compensation and signing bonuses for ICE personnel.
Yes. Incentives for ICE agents, officers, and attorneys who commit to additional years of service. A recruitment and retention tool. And it provides specific definitions for criminal alien and custodial alien, likely relevant to enforcement priorities or state cooperation. There's also a specific appropriation of $20 million for the Office of the Principal Legal Advisor within ICE for FY 2025. That's ICE's legal arm.
Okay. Shifting to telecommunications. Something about spectrum reallocation.
Yes, a directive requiring the president to identify and reallocate at least 600 megahertz of spectrum. That's the radio waves used for all wireless communication. This spectrum must be shifted from federal government use to non-federal use, specifically for broadband. And this has to happen by October 1st, 2029. The insight is this is a specific target and deadline aimed at freeing up valuable spectrum for commercial broadband deployment, potentially impacting 5G or future wireless services.
Now, artificial intelligence, there's a notable prohibition mentioned here.
Yes, quite notable. It says federal agencies are generally prohibited from imposing new requirements on AI models or systems, unless those requirements are based on existing federal law or they are based on generally applicable laws that would apply equally to non-AI systems doing similar things.
So it's trying to limit agencies from creating AI-specific regulations.
That seems to be the thrust. The insight is it's a legislative effort to put the brakes on federal agencies creating new AI-specific regulatory frameworks on their own initiative. They'd need to tie it back to existing laws or apply rules neutrally across AI and non-AI systems with comparable functions.
Yeah. And transportation.
Yeah.
A new fee structure for state DMVs.
Yes, a new fee structure is introduced for state motor vehicle departments. They'll be charged a fee per transaction, things like vehicle registrations, renewals, or title transfers whenever they transmit data to a federal system. These fees will also be adjusted for inflation. It's a new administrative cost for states that could, indirectly impact vehicle owners down the line, maybe.
There's also specific funding allocated, $5 million for the FMCSA.
Right, the Federal Motor Carrier Safety Administration. That funding is to create a public website displaying motor carrier safety status information, a relatively small but specific digital initiative for trucking safety data.
And similar to other sectors, rescissions of funds for specific highway programs.
Yes, cuts mentioned for programs related to carbon reduction in transportation and grants for using low-carbon materials in highway construction.
But counterbalancing those cuts, there's a significant appropriation for the FAA.
Yes, a large one. $2.16 billion for fiscal year 2025. Directed specifically to the Federal Aviation Administration for air traffic control staffing and modernization efforts. That's a big investment aimed squarely at improving air travel infrastructure and addressing controller shortages.
Okay, these sector-specific parts really show the granular level of detail, don't they? From funding specific missiles to regulating AI development and streamlining energy permits, it's deep in the weeds.
Absolutely. Real policy choices embedded there.
All right, finally, let's just touch on a few other notable provisions that kind of stood out. things that might not fit neatly into the previous categories we discussed.
Okay. Well, there's a filing fee established for the Merit Systems Protection Board. That's the board where federal employees can appeal certain personnel actions, like firings or suspensions. The fee is set at $250. It is returnable if the employee wins their case, and there are some exceptions listed for certain types of appeals. But still, it introduces a potential cost barrier to initiating those appeals.
There's also an increase mentioned in the excise tax on firearms.
Yes, on manufacturers and importers of firearms and related items like shells and cartridges. The document specifies different flat dollar increase amounts depending on the item type. For example, pistols and revolvers see a $100 increase per item. Certain weapons like short-barreled rifles and silencers, a $500 increase. Other firearms, a $200 increase. This is a direct tax increase levied at the point of manufacture or import for these specific items.
Modifications are also made to the de minimis entry privilege for commercial shipments. What's that about?
De minimis affects imports. It's the value threshold below which goods can enter the country with fewer duties, taxes, and less formal customs procedures. Currently, it's $800 in the U.S. The document mentions modifications and imposing civil penalties related to it. The insight is that changing these rules impacts the flow of international trade, particularly for e-commerce and small-value shipments. Depending on the modification, it could make importing cheaper items more complex or costly.
Okay. And here's another new tax that jumped out, a tax on remittance transfers.
Yes, the imposition of a new tax on money sent abroad. It's described as a 3.5% tax on the amount of the transfer, is paid by the person sending the money and collected by the transfer provider, like Western Union or a bank.
But there's a few exceptions.
A very key exception. The tax does not apply to transfers sent by U.S. citizens and U.S. nationals. So the insight is it's a new tax specifically targeting certain money transfers out of the country, primarily those sent by non-citizens, with citizenship status being the determining factor for the exemption.
Wow, okay. These other provisions really highlight just how many different, sometimes unexpected areas a single piece of legislation like this can potentially touch.
It really does.
So after going through all that, what does this all mean? Our deep dive into just these excerpts of one document reveals a legislative proposal that touches upon an incredible range of issues, affecting potentially everyone's lives in some way.
Absolutely. We've seen proposed changes impacting how you might pay taxes, new deductions, new account types, new remittance taxes, how you access healthcare, eligibility rules, insurance renewals, how you use education savings, what counts as an expense, how businesses are taxed, R&D incentives, opportunity zones, where defense money is allocated, specific weapons systems, rules for energy projects, permitting reform, fees on public lands, border security funding directed to states, immigration court fees, and even specific administrative fees or taxes on items like firearms. It's incredibly broad.
It really underscores the sheer complexity, doesn't it? And the interconnectedness of federal policy. This wasn't an exhaustive reading, obviously, of every single line in the document we had access to, but we've definitely pulled out many of the key changes, new programs, fee structures, directives, and insights across these vastly different areas.
And it highlights that legislation isn't often neatly siloed into single topics, right? Changes designed with one sector or goal in mind can indeed ripple out into unexpected areas, sometimes with pretty significant and far-reaching effects that maybe weren't the primary intention.
Okay, so let's leave our listeners with this. Here's a final provocative thought for you to consider. Given the vast scope and the really specific detail packed into just the excerpts we looked at from this one document, how challenging is it really for anyone, whether they're inside or outside of government, to truly grasp the full potential impact of complex legislation like this before it becomes law? And what are the potential consequences when these complex policies inevitably intersect in unforeseen ways? Something to think about.
Definitely something to think about. Thanks for joining us for this deep dive.